Vamos a empezar 7-10, chavos, buenos días.
Gracias, profe. Buenos días.
For everyone just connecting, we're going to start the class at 7:10 because there's still a lot of people missing. Okay, guys. So I think we are all now connected. Well, maybe two people are missing. Yeah. Let's start anyway. So where we left last class?
With case 3.
Case 3, right? And I told you I was going to explain you the case. No, I already explained you the case, right?
Yes.
What you need to do now is work on the case. So let's do a quick recap of what you need to do now, so you can work on it and remember. Well, so you can remember what we were doing and you can work on it. Now, what we were seeing last class is that what happens when you have inventory left over from the previous period, and then you need to sell it in the next period. That is, maybe in the previous period, your sales were lower than your production. So you end up, let's put it here, period 1, and then you have period 2. So in the previous period, maybe you saw sales. Maybe you saw sales. What happens? Maybe you saw sales that were smaller than your production. Let's put it here, sales smaller than production. And in period 2, now you have sales which are greater than production. Okay, so this means that you need to take from someplace else the units that you're going to be selling on period number 2. And some of you had the right idea saying that we needed those units from somewhere else, and you thought that the best idea was maybe to outsource the work, buy them, or something like that. But the thing is that what I want you guys to think is that you have inventory from this one that you need to take to the second period. And there is a chance that the inventory on period 1 has a different valuation that the inventory, or not the inventory, that the production valuation you have on period 2. So that can happen. So the thing here is how we can see that effect in both of the variable and absorbing type of analysis. So let's do an example. We have a beginning inventory, which is 3,000. That is the leftover production we had from previous period. So this one is our inventory. Because we have that leftover inventory, on this period, we're only going to produce 10,000. So this would be period 2 production. And because this is a business and we don't really know what's happening, we managed to sell 13,000. So these are the sales from period 2. And as you can see, we have sales bigger than production. So that difference, those 3,000 are gonna be filled with 3,000 products from the beginning inventory of the previous month. So that's basically it. We need to recognize the inventory from the previous month inside the new analysis. So the first thing that we need to do is evaluate production. So production. And we need to evaluate production from both the inventory and the period production. And you can see it here. You have the beginning inventory and the production cost. And what we need to have is the unit cost of each. So what we're going to do is we are going to take the value of the previous inventory and we're going to divide it by the units. And there, I have my unit cost. Pretty easy. It's a acquisition cost valuation. So nothing more to it. And then we do the same to the next one. And in the next one, you realize now we have different numbers here, which means our cost is going to be different. Okay, so again, we do a valuation, simple valuation, because these are interchangeable products. We can apply average. So that's an average. and we get 45 pesos as unit cost. The one thing I want you guys to see is that the unit cost is different from period 1 to period 2. It increased. Okay, so now we have that, and from the sales general administrative or variable cost of sales, it's related with the sales, which is 15,000. So we have the unit variable cost. Questions so far? Questions? Questions? No? Are you sure? Okay.
Sure. Thank you.
So the first thing we need to do is bring back the inventory. And as I told you, our inventory is 3,000. So we need to bring that at 35. Why at 35? Because we already saw that's the value of the beginning inventory per units. So that times that is 105. So we are bringing back that inventory, and our production is 10,000 and it's worth 45. It's here, the 45. So that's 450,000, and of course don't forget to evaluate your sales, which is 15,000 times 50. That's here. It's 13,000 actually. I'm sorry, this number is incorrect. Okay, so we do that. Now we have the cost, and if you realize something is that this cost is not the same cost as the period production. Period production was 550, and now it's 555,000. Why is that? Well, because you are adding up the previous month production, because now you're bringing in inventory. So because we are bringing in inventory, we have that increase on cost. Our gross income decreases. We report our sales general administrative together, that is fixed and variable. We don't do the separation, and we have our result here of sales general administrative, and that gives us, in this case, a loss. It's possible to have a loss, yes, of course. So we have a loss of minus 13,000, minus 30,000. I'm sorry. Okay. And now I want you to see that the 30,000 are actually here. It's the fixed cost of the beginning inventory. And why is that you see it here? Well, I will tell you at the end of the example. But now let's see the variable. So in the variable, we do the same. We have 3,000 units that need to come back to the income statement. But now they cannot come back at 35 because at 35, it includes both variable and fixed costs. And because we are doing the variable, of course, we're only going to include the variable cost. It's that easy, just variable, not fixed. And because that's the variable, not the fixed, we only need to multiply times 25. And we do the same for the 10,000 units of period production, which are at 30 pesos per unit. So we multiply that times 30, and that's your cost. Again, remember to multiply your sales. Okay, the addition of those two is the cost. Check that this one it's lower than this one. You see it? Why? Well, because remember here in these numbers here you have fixed costs, and in here you only have variable. Okay, so that's why this one is lower. And if this one is lower, or manufacturing margin is going to be lower, manufacturing profit, I'm sorry. Then we need to include the variable, sales general, and administrative. These are only the variable. Remember here we're doing a separation between variable and fixed. That's going to give us our contribution margin, and we end up with the fixed cost and expense. Cost plus expense, right? That's 200,000. And look at that. Here we don't have a loss. That is, we lost more money in the absorbing method reporting than in the variable method reporting. Now you can see why it's important to know which reporting method you are using, because which one is actually a real one. I mean, if you think about it, here you had a bad business, here you had a not so bad business, not so bad month. So maybe you have an investor, you will be inclined to show him the variable method of your income statement, because you have less, you have less loss in that period. That's why you cannot use the variable method to report information, because when you are actually selling things with previous period production, it will give you an incorrect number. So variable reporting, it's only used internally for analysis of the contribution margin, right? This is a number you want to analyze when you're using variable, not this one. And why is that? Why do I de-estimate? Why do I not take into account the fixed cost in my analysis? Because maybe what I'm doing is I want to know if my business generates money only with variable cost. And why only with variable cost? Well, remember the graph I've been talking to you guys about. The sales move like this. Not like that, of course. The sales move like this, okay? And our variable cost is gonna closely follow our sales like that, okay? And because a business is mostly dedicated on its sales, what you actually want to know, it's these points here when you have a loss on the variable cost uh, compared to the sales. And why is that? Well, because if you are here, it means that it doesn't matter that your fixed costs are here or whatever they are. Here, the production is not being it's not being efficient enough to cover the cost of sales. That is, the cost of the product you are selling is not being covered by the sales. So that's a problem for any business, because it doesn't matter how you manage the business. Here it's telling you that maybe you are inefficient, maybe you are on a declining economy, maybe you are maybe you got caught by innovation, you are obsolete right now, and you don't have your business is just dying. Okay, if you have sales, if your sales cannot cover your variable cost, it means a stronger problem for your business, that way they cannot cover your fixed cost. Because remember, fixed costs can be reduced with different management. Fixed cost tends to be more of a management operational issue. Variable cost is related with the production and the serving of the business. So it's really important for managers to have a really control and understanding of that cost. And this analysis helps you to do that. Okay. So just to recap, the reason why we got a bigger profit in the variable expense, in the variable costing, I'm sorry, it's because right now the fixed cost of manufacturing the inventory in the variable cost was shown as an expense from the previous period. That means that in this period, we don't include that fixed cost. And if we don't include the fixed cost, it means that we actually are not recording that money going out of the company. So we get a bigger profit. Okay, and if you see, I put it here. The 3,000 are here. The 30,000, I'm sorry, are here, and the 3,000 units are here. This is the fixed cost per unit, and the multiplication of these two is the fixed cost that in the variable cost got reported as a previous period expense, and right now it's just not included in the next period because we only include variable cost. So that's the reason, that's the way to do it, and that's the way to analyze it. If you don't have any more questions, we will now go to case number 3 on the Excel spreadsheet. Unless you have a question. Do you have a question?
No, teacher.
Are you sure? You are awfully quiet.
Yeah.
Yes, okay. So let's go to the breakout rooms. Try to participate and finish the case. I will be visiting the breakout rooms.
Thanks.
Prof, can you send me to my breakout room? My
Uh,
internet is very bad, and I think it like me
Okay.
sacó por.
Done. Didn't work?
¿Cómo se llama el documento?
Se llama Variable and Observing Cost.
Ajá.
Luego, aquí es este, ¿no?
Sí, creo que sí. Sí, sí, sí.
Ese por, creo que las unidades, ¿no?
Sí, pero ¿por cuáles? Por las de...
Por esta, porque es el absorbing.
Ah, sí, entonces sí.
Entonces es esto por este, ¿no?
Are you
Ahí.
sure?
Ay, no.
It's the
Ya,
beginning mentor.
Ese no está ya, o sea, no es el 424 no está ya multiplicado por el 12.12.
It's the beginning
sí, es
mentor,
el
remember?
resultado de 35,000 por 12.12, ¿no?
Yep.
Según yo ya está.
Sí, entonces solo el 424.
Ok.
Hello.
Hello,
Hi.
teacher.
So how you are doing?
I think we're fine.
Great.
En, en BCOP, según yo, es el inicial, ajá, que sería 35 por el 12. Sí, según yo está bien así, ¿no? Y en el de abajo sería igual, pero en lugar de los 35 sería 20,000, ¿no? De los manufactured. Pero también sería por los 12.12 o si sería por 22.50.
Según yo sería por los 22.50.
Según yo también.
Va. Sí, está bien, eso se suma, luego se resta, ¿no?
Sí. A ver, este no sé si es sí tal cual. Aunque está acá.
¿Los 50?
Igual a esa. Y ahí se suma. No, la suma va abajo. No, o sea, abajo de
Ok.
55 y 50.
¿No va acá? ¿Y aquí va el resultado?
Bueno, sí, se jala. Entonces, no hay problema, ponla ahí.
Y esto se lo resto a este, ¿no?
Sí.
Sí.
¿Así?
Ujú.
Ok. Ahora las sales serían las mismas, ¿no?
Sí, son las mismas.
Y este sí es diferente, según yo. Tenemos ese el variable.
Ahora
de
serían los
este por
185, ¿no?
Exacto.
no sé. Así.
35 por 8
No
por
por.
6.80.
¿No se está así?
Ajá.
Ah, sí, es que no veo, perdón.
Y el production igual es el variable.
Sí, igual.
Ok.
20 por 15. Bueno, 20,000 por 15.
Y se suma.
Según yo sí se hacía como el de arriba, de que eso se restaba con los ceos. Según yo sí está bien así. Y eso... 75.
Pues yo creo tal cual que era este, pero no sé.
Sí, según yo sí se pone tal cual.
Va.
Y luego se resta.
85,000, ¿de dónde lo sacaste?
¿Cuál 85?
Yeah, where
El
we find-
185,000.
Oh.
¿El cuál, perdón?
El que está en amarillo.
185,000, that one.
Ah, okay. This one was from here.
Ah, ok.
Remember, it's just the variable costing. So she's including the variable cost of the beginning inventory. Right?
Yes.
Yes, in English. Thank you.
Okay. ¿Cómo calcularon el production cost nada más?
A ver dónde está.
El de hasta arriba. ¿En sales?
O sea, este.
Ajá. Ah, ok, va. Gracias.
Y aquí como que es variable nada más.
Now check if what you did is correct and look at the yellow, what is that, square, rectangle at the bottom, what it says. It says the difference is the same fixed cost that in the last period went to the balance sheet and in this period comes back as cost of goods sold. So take the difference between the two operating incomes.
Yeah, that would be this.
Yeah.
The difference?
The difference between those two operating incomes from variable and absorbing. So if you did if your analysis is correct, that difference should be equal to the fixed cost of the beginning inventory.
Whoa.
Yep, you see?
Okay, so that's how we check it.
That's how you check it, yeah.
All right, perfect. Thank you.
So you are correct, you see? Good job.
Wow. Excellent.
Hi, teacher.
Hi, so you finished? Great. Now check if the result you got is correct. So if you see at the yellow rectangle, it says difference is the same fixed cost that in the last period went to the balance sheet and in this period comes back as cost of goods sold cost, right? So that 238,824 pesos should be the same as the fixed cost, the fixed value of the beginning inventory. So
Yeah.
check that's the case.
Yeah, we did.
You did great, you're really smart.
Yeah.
Perfect.
Las sales. Y ya con lo demás sacamos lo que nos piden.
Did you finish already, guys?
Teacher, we had a doubt.
What is your question?
Here, it is not formulated.
No,
So-
because that's what you need to find. So it says there, the difference is the same fixed cost in the last period went to the balance sheet and this period comes back as cost of goods sold. Now this is like the check part of the analysis. So just take the difference between the two operating incomes and put it
So
there. Just
this one.
that one minus that one. The 614 minus the 375 or inverse, it's the same.
Okay, so it will be this one minus this one.
So that number has to be the same number as the fixed cost of the beginning inventory. So go to the top of your page and look for the fixed cost of your beginning inventory and see if it is the same value.
Ah, sí, sí es.
So that means you did that right. You did it correctly. You see?
Here, but what is in negative?
Because you put it, you put the 375 first. You should have put it 614
Okay.
minus 300. But it's. I mean, it's just an analysis. So you know it's negative because you mix the numbers, but it's the same. There.
Okay. Now it's correct.
And now the important thing is not why it's negative or why it's positive. The important thing is that you understand why is that number.
Okay.
And you understand the reason is that the difference is the same fixed cost. That's the reason why it's that number.
Teacher, and in general, it's the difference between the beginning and the previous moment.
The value?
Yes, the 238.
No. The difference is the fixed cost of the beginning inventory. Or I'm sorry, I didn't understand your question.
Yeah, and if it is the difference just to the beginning to this moment in fixed cost or something like that, or what it represent?
It represents the fixed cost that in the previous month you register as period expense. So go to case number 2. All right. So now here in the variable, you see that number.
What number?
200. You see, it's the same. You see?
Yeah.
So that difference is because in this period you are recognizing that extra fixed cost, 238,000.
Okay.
That one comes from the fixed cost that in this period you already registered inside the fixed cost as a period expense. Where? Well, in the 580, well, you move to the other one. But in the case 2, it's inside the 580,000. In the cell I-40, what? 41. I-41.
Where, teacher?
Cell I-41. 41, yep. And I. So inside there, that 580,000, it's an extra 238,000, which is the fixed cost of that inventory. So in this period, I don't remember who was asking the question. Who was asking the question?
Sorry. Okay. Yes.
So in that period, you recognize the 238,000 inside that number. Okay? So it's not as, I mean, it's not a difference between the 2 periods inventory, more of a difference between the 2 periods reporting. Okay?
Yeah.
Because in the next period, you already registered that sale, that sales cost, I'm sorry. So if you were to register it again, go back to case 3, please. To caso 3. If you were to register it again, you will be duplicating that cost. So you don't take into account. And that's the difference. Yeah.
Okay, teacher, thank you. Yes.
En income de arriba, en
Got
la
almost there, guys?
35.
Yes, thank you. I just have a question.
Mm-hmm.
In the end, we have to subtract the margin contribution with the total of gasto de administración, and that's our utility of operative utility.
Yes, operating profit. That will be your operating income. I'm sorry I didn't translate that there. So yeah, you need to subtract the 814,000 minus the 200. That one minus 200. And now check if what you did is correct. Just take the difference between the 2 operating incomes, both methods. The difference between the 2 operating incomes.
35 con el 50. No, el
No, the 375,000 with the 614.
Right, we subtract them.
Yeah, just take the difference because you're gonna see if it's correct. If your analysis is correct, the difference between those 2 operating incomes should be the same number as the fixed cost of the beginning inventory.
Oh yeah, it's
the same. You see? So you
are
correct. You did it correct.
Thank you, teacher.
Okay, I think you all finished, so I'm gonna close the breakout rooms. So you all did it correctly. I think you all understood what you had to do. So I'm not gonna review the answer. I'm just gonna change here this, and please do the same in your Excel spreadsheet, because I had it in Spanish. All right, I forgot to translate that. So do that. Just copy from here to here. You know, Control C, and then just Control V here, and that's that. So what you need to do is the same as in the previous one, with a minor difference that in this time you needed to evaluate your beginning inventory. Instead of subtracting an inventory going back to the balance sheet, you were adding an inventory. And as you all did correctly, you choose the total cost to evaluate that in the absorbing, which is correct, and you only choose the variable cost to evaluate here, which is also correct. And well, ignore this number. I was just checking to see if I had the right answer. And as you can see, we have the same numbers. And the important thing here is that you actually check that the difference between the two methods is the same as the fixed cost in the beginning inventory. Okay.
Yes.
So that's the answer. So what is what we learned here? When you are doing this valuation, when you have the same units manufactured and units sold, the absorbing costing will give you the same income from operation as the variable costing, right? If you are selling what you produce, there is no difference in the two methods. If you are manufacturing more or what you are producing, then the absorbing costing of operations will be bigger. The absorbing costing and also the income from operations, the operating income will be bigger than the variable costing. Why is that? Well, because all of this extra production will be taken to the balance sheet. And as it's taken to the balance sheet, it goes out of the income statement. And in the variable cost, it doesn't. It stays as a period expense. So that's the difference, and that's the reason. And when we are manufacturing less, or when we are selling, the variable costing, the operating income in the variable costing will be bigger. And what is the reason? Well, because the inventory coming back to the income statement in the variable cost, it's already registered as the fixed part of that inventory. It's already registered as a period expense in the previous month. So in the current month, when you are producing less and you are selling your inventory, you have a bigger operating income of the absorbing costing. Why? Well, because in the absorbing costing, you have an extra fixed cost that you have to recognize. Why do we use this analysis? I mean, is it worth it to do that? Well, day to day, you will actually use the absorbing method. Absorption. All right. Absorption method. And why is that? Well, because that's the way you are supposed to report all your information in your financial statements. That's how the norm asks you to do it. So what you will be doing actually, it's converting absorbing method of costing to variable method. And why is that? Well, because in the variable method, as I told you, there is a way you can control costs. You can also check and determine prices. You can plan production and mix of products, and you can analyze marginal contributions. And that's the important thing when you are doing costing, is to know the marginal contribution, because that's how much money you gain for each article sale. And so it's a task of corporate finance. It's analysis inside a business of the information for production. Let's see an example of analysis. So let's see an example of analysis when we take the information, we turn it into variable. So we have two products. We have blue calculator and a green calculator. We have two prices. We have two variable costs. We have two variable sales general administrative, SG&A. We have two sales commissions. We have 2 months of sales, and we have 2 months of production. So we are going to take all this information and we are going to turn it into small income statements just to see the variable gross income, because that's the one I want to analyze right now. So I have my sales. Remember, sales is it's sales times the variable times price. I'm sorry. So that's there. I have a variable cost of goods sold, which is my unit variable cost of goods sold times the sales, which in this case is the same as production, and so on, right, in the analysis. And I want you guys to tell me at this point of variable gross income, which of the two products seems to be the same, the best, I'm sorry. Should I be selling more blue calculators or green calculators at this point here?
Blue calculator, right?
Blue calculators. Yeah, I mean, at that point, it seems that I have to be selling more blue calculators than green calculators. But remember this variable costing, so we are going to add more variable cost. That is sales general administrative variable cost. And when I add that, well, hold and behold, it seems that the best product is not the blue calculator, it's actually the green calculator. Even though it has a higher production cost, it's cheaper to sell, you see? So it has a bigger contribution margin. That is, I gain more money per calculator sold if I sell green calculators, I'm sorry, against the blue calculators. And why we know this? Well, because we are including inside the cost as contribution margin variable expenses of the period. So that's the way you use that analysis. And with that analysis of margin in the variable cost, maybe we can demand better results for commissions agents of the blue calculators. I can tell, look, man, I am paying you a lot of money and you are selling less calculators than the guys in the green division. And so you need to increase those those sales numbers. And also you are paying a big commission price here on sales, 10% against 2%. And maybe the reason why you are selling less blue calculators than green calculators is just the price, right? Maybe it's a commodity product. So we can analyze the reduction on the price. Maybe a reduction on the price would actually increase the volume of calculators sold. And in that case, you will gain a better contribution margin on the blue calculators. And as you can see, I mean, these are the two analyses you can think right off the bat when you are doing the variable analysis on these two products. But the analysis could go forward. I mean, you could even ask, why the hell does this one it's so low and this one it's so high, right? If my blue calculator is 80 pesos the unit, why am I spending so much money manufacturing green calculators? So other analysis could be also, let's check what is the cost of production of these two products, right? And those are the types of analysis you can do, and that's the use of this analysis, understanding absorbing and variable cost. Great. Do you have any questions?
No, teacher.
So please go to your Canvas. Go to the cost profit volume, right? Well, it's actually cost. No, yeah, it's cost volume profit right here. Go to this activity and download this Excel spreadsheet. Because we are going to start a new subject. I think 2 classes ago, or maybe last class, one of you asked me like, why is the use of learning these things? Who was? Do you remember?
I think it was me.
It was who? Leslie?
Sophia.
Sophia. All right, Sophia. The reason why we are learning these things is because one thing is to know how to calculate cost and actually build an accounting financial information. Another thing is to know how to analyze it. All right? Okay. Yes. So this course is divided into two sections. First part, which was the first 2 weeks, is just learning the basics of accounting and the basic of cost accounting and knowing how to evaluate and determine the cost of a product. So basically a really operational part of the class. Just learn how to calculate a cost. That's it, right? These 2 next weeks have been about analyzing that information, and maybe with variable and absorbing costing analysis, it's not that clear because I'll give it to you. It's a lot of work for a little small analysis. I mean, at the end, you only apply variable cost and then you get to analyze the information. But that doesn't mean that the analysis of financial information is not useful for business decisions. So this part of the class this week that we are going to start today It's actually about analysis, and we are going to learn. I'm going to teach you a type of analysis that is called cost volume profit, right? In the cost volume profit, Sophia, because you were the one who was asking, it's just about taking out ratios. It's learning how to do the break-even point, learning how to calculate the marginal contribution, learning how to calculate profit goals, for example. It's really about analyzing the financial information to take business decisions.
All right.
Okay, so that's what we're gonna do. I'm explaining because I think your question is great, Sophia. Last class, I don't remember if it was last class or the class previous to that one. But when you ask it, I like the question because that's what you should be thinking about when you see financial information and corporate finance. It's not just about knowing where an income statement is. It's about knowing how to analyze it. And I can tell you for experience that if you don't understand accounting and understand financial statements, you cannot do analysis of financial statements. When I was working on corporate finance as a cost controller, I knew exactly when I was dealing with people that didn't understand finance, even though they maybe had an MBA or a corporate finance course or whatever. If they didn't understand financial information at its core, that is accounting, they couldn't do proper financial analysis because they couldn't connect, all right? They couldn't connect the result of the analysis to the base of the analysis. That is, all we are analyzing right now comes from the cost of the product. Right now, you know that the product has three elements. You know that it has labor, it has raw materials, it has overhead expense. And if you analyze maybe the break-even point and you see that you need to cut cost, you know that you need to cut one of those three things. It's just not a number for you now. It can actually become, it can turn into a business decision and an activity that you can set inside a company as a goal. Let's reduce cost, firing people, for example. I hope you don't do that if you happen to work on that with that. If it happens, well, you know you can reduce cost by doing that. So that's what we're going to be learning. We're going to be learning this analysis. There are six, well, maybe I went ahead of myself. There are 6 types of analysis for break-even point. Contribution margin, I'm sorry, not for break-even point. For cost volume profit analysis, it's contribution margin, break-even point, profit goals, cost profit value chart, CPV, I'm sorry, it's called, operating margin, and safety margin. So those are the 16 we're going to be seeing in this part of the class, in this week. And before we get into that, I need you guys to remember some key elements of analysis of cost. These are the 4 key elements I need you guys to remember. First is definition and classification of cost. That is, remember the cost classification by period, by function, by time. All of that, we need to have that in mind. The cost elements, I already gave you an example why it's important that you know what the cost elements are. Determination of unit cost also because it helps you to analyze that from a more managerial point of view. Because now that you know how to determine cost, if you also know this analysis, you know how to manipulate it. And of course, the identification of the information in financial statements. You need to know what a cost is and where to find it in the income statement. And you need to know what is the difference between the cost and the operating expense. That is a classification of cost and expense. And you need to understand that to work and do a proper cost profit volume analysis. That's why we saw first all of that things at the beginning of the class. And that's why now we are going to be looking at analysis. Let's do a recap of the variable cost identification because I need you guys to really grasp the difference between variable, fixed, and mixed cost. So let's first see this example. A company that markets notebooks buys the materials to assemble. I'm gonna do a quick parenthesis here because I'm feeling I'm going too fast. No one is interrupting me, so it's good. Are you guys feeling good?
Yes, maybe a little bit slower.
Okay, so I was going too fast. Okay, so I'm gonna reduce the speed a little bit. So I was telling you guys that we need to recap the variable fixed cost identification because you need to have that pretty well identified for this analysis of cost volume profit ratio to actually work, okay? So we are gonna see some examples so you guys can review that again, all right? So you can remember it. So let's see this first example to identify variable cost. And this example says that we have a company that markets notebooks, all right? So the company goes out, buys the materials to assemble the notebooks, and it pays 10 pesos per unit of material. That's it. He goes, buys its raw materials, and each unit costs 10 pesos. What raw material is? Whatever. It's material used to build notebooks. But the thing is that it's 10 pesos per unit. The notebooks are assembled by an outsourced facility, and the total cost of production is as follows. So, as you can see, the direct cost of each period, it's always 10. Why is always 10? Because that's the price you have per unit of variable cost. But when we look at the total cost, you can see that this one increases for each period. It increases, and it increases. Why is that the total cost is increasing? Well, because the total cost is a function of the number of notebooks, that is the number of products, times the unit cost. So my total cost, it's equal at unit cost times units produced. Really simple, it's just a multiplication. And see that this is a variable cost in the total analysis, but it's a fixed cost in the unit analysis. You can see that unit cost is the same, total cost moves with production. Even though this is variable, I want you guys to understand now that a variable cost in the total analysis should be fixed in the unit analysis, because the raw materials are fixed per unit, but they vary with production. No questions?
No, teacher.
Let's see it as graphs. So total materials going, again, this is time and this is money. You can see how as time goes by, it costs you more, right? Because production moves with time. So this will be the total cost variable. But when you see it here as unit, and this again is money, you can see that it's always the same. It's always 10. Why is that? Because when you have unit cost variable, it will always be the same. It should be. It's fixed in the variable. It's fixed. I'm sorry. It's fixed in the unit. It's variable in the total. If that's what happens with the variable cost, what do you think is going to happen with the fixed cost?
It would change.
Change how, Katia?
The cost, the unitary cost will increase.
Will be variable.
It will not be the same.
It will not be the same. Great, you are really smart, Katia. Thank you. So let's see the same example, and now you have a fixed cost inside the example of the notebooks, and you have different levels of production. You see, it goes up. And look that the total cost doesn't move, it's fixed. We just, as Katia predicted, the unit cost in the fixed analysis, it does move, all right? So when you have total fixed cost, you have variable unit cost. Because this is a function of production again, but now the function is production divided by the fixed cost. That will be your unit cost. Right? Let's see it as graphs again. We have time and we have money. And as you can see, in time, the fixed cost, it's always the same. It's the same value in the total cost. But in the unit cost, the fixed cost moves with production. As time goes by, and if your fixed cost remains the same, you have a lower and lower unit cost. Now, this what I'm showing you here, it's the reason why internet business are so incredible profitable. Because internet business have huge fixed costs, but the more users they get, the cheaper the unit cost becomes. For example, Uber or Airbnb, they have this huge cost that they pay off with with angel investors and funding and capital runs and whatever, all of that money they raised, whatever they did it, and they invest that in the company and they start developing this huge tech infrastructure, like a lot of money they spend on that. And at the beginning, of course, it's gonna be like really expensive just to get one user. But once you have like a critical mass of users, the unit cost just drops like a brick, and then you have huge profit margins. When that happens, you have companies like Google, Facebook right now, even Amazon just making a kill. I mean, they are just money grab machines. They are incredible business because they manage to turn a fixed cost in the total to a really cheap variable cost in the units. This is the reason why internet companies are so valuable in the stock market, because they have the ability to turn huge unit profits.
For example, for Amazon, the 99 they have for their subscription, it wouldn't be like they wouldn't make any money out of it if they wouldn't have so many customers, right?
Exactly, Guillermo. Exactly. So when you are looking, for example, to buy a stock of Amazon, and if you think at the first classes I told you that the Amazon income statement and balance sheet looks a bit as a Walmart balance sheet, but then why the stock of Amazon is like 10 times the value of the stock of Walmart? Well, because Walmart doesn't sell subscriptions. Walmart has only variable cost, and it has it. That means that every time Walmart sells more, it costs more to sell. But that's not the case in Amazon, because Amazon managed to build a retail business in the internet. That means that they can get money on subscriptions. And just as Guillermo was explaining, pointing out, I'm sorry, the more users they get, the cheaper the cost of each subscription of Amazon Prime is. And the more money they gain.
Same with all like streaming services like Spotify, Apple Music.
That's the reason why. Who likes investment analysis? Who can tell us? Well, maybe you like Guillermo, and that's why you're talking about that. I don't know if you read about Disney Plus.
I didn't read much about it.
I don't even read about that. Disney Plus is a thing. It's been a thing like for 2 years now. If you follow financial news, you know that Disney actually was maybe like 4 years ago. They decided that they were gonna launch their streaming service, and that's why they bought Fox, and that's why they bought Hulu, just to get that technology and that content there. But something that happens just the previous year. Not the previous year, it was actually this year. They announced to their shareholders that they're gonna cease production of major motion pictures outside the streaming service. That is, Disney is not gonna be longer distributing its movies on cinema. All right? They're gonna only distribute the movies on the streaming service, on the streaming platform. They have something like 80 million users, something like that right now. It's been live like 1.5 years. And I want you to think about that, and I want you to think about cost, all right? So think about this. If you make a movie, the movie is gonna cost you like what, $200 million? And when you have the movie already done, and you want to distribute the movie to get the money from the cinemas, you need to pay what? You need to pay commission to each cinema. So the more you distribute the movie, the more money you pay. You see that?
Yes.
So if I want the movie distributed in Asia, I need to pay all those Asia cinemas to actually distribute the movie, and I need to pay for advertising in that country, and I need to pay a lot of things. And if I go to Europe, I need to pay that again. And maybe if I go to France, well, not maybe. If I go to France, it's not the same to go as if I go to Spain, because they speak different languages. Laws for advertising are different. Even if I go to Spain and then if I go to Mexico, it's going to be different advertising, a different advertising strategy. Therefore, different investment for the different investment costs for that distribution. So if you think about it, it's actually a variable cost for Disney and for every other major movie distributor and producer. That doesn't happen when you have a streaming service. For example, Netflix can invest $200 million inside a movie and have it more times viewed in its platform than Disney had. Why? Because the platform is already inside the business, inside inside the household of every user. And even though the user doesn't charge per movie, doesn't pay per movie, I'm sorry, it's still profitable to Netflix to do that, because the more content they generate, the more users they get, the more subscription-based model they have, and the fixed cost it's driven down. That is, they earn more and more and more money. And if you see the value capitalization of Netflix against Disney, right now Netflix, it's worth more than Disney. And just remember, just think about that. Disney has a lot of fixed assets. They have these amusement parks everywhere. They have production houses all over the world. They have their distribution capabilities and facilities. I mean, Disney is a juggernaut on fixed assets, and it's worth less than Netflix. And Netflix is only a few computers on Palo Alto, California. So just think about that. That's the magic of internet business. The ability to turn a variable cost into a fixed cost and then drive down the unit cost by getting more and more and more units, more and more users, I'm sorry. So that was the explanation of fixed cost. Now let's see what happens when we have a mixed cost, because you can have a mixed cost. That is when you have a fixed part of the cost and then you have a variable part of the cost. A really nice example of that is when you have a lease on machinery, because you usually will have a fixed payment of the lease. And then if you are in a manufacturing business, there are these contracts when you pay extra for each unit produced. So let's think in this example that we start with 8,000 pesos, 8,800 pesos as a lease payment. And then, and you see it's a lease payment, so it doesn't matter how much notebooks you manufacture, it will not increase. You need to pay that right off the bat. And as the production increases, then your price of the lease increases. Well, it should be like that. It increases, okay? If we see it in a table, it will, in a graph, it will just look like this. The more you sell, the more you produce, I'm sorry, the more it's gonna cost you. So it kind of looks like a variable cost, but look, it doesn't start at the bottom, at zero, like a variable cost does, right? It's driven by both a fixed cost, because it starts here all the time, and a variable cost, because it will increase with production. Yes?
Yes, teacher.
Can you give us like one example of a company that has mixed cost?
Well, a manufacturing company can have a mixed cost. I know this example because it's a client of mine. They have this machine that they bought, and it's actually connected to the internet. It's really strange machine. And they pay a fixed lease each month to have the machine in their factory. And as they produce, the machine sends that information to the data center in the United States, and the United States and the headquarters of the machine actually modifies the lease price according with the production. So this is a real life example. It does happen. It can happen like that. Other example is also, again, let's go to the internet business. I don't know if you guys know what Amazon Web Services or Microsoft Azure are. No?
No, teacher.
Well, when you have a web page, like a huge web page that is a web app, you need to host that into a dedicated server. And those servers, the two biggest providers of those servers as VPNs are Microsoft Azure and Amazon Web Services. Actually, you know what SAT is? Mexican SAT, Servicio de Administración Tributaria?
Yes.
Well, that service and that web app that they have for us to pay our taxes is actually built on Microsoft Azure. So it's like computer, so it's a cloud computing software but it's huge. It's really, really, it's a data center. It's really big and it's really expensive. So when you register your software in one of those companies, you pay a fixed amount each month just to use the service, and then you pay a variable part of the lease each month according with the consumption of memory on the data center, right? So that would be also a mixed cost.
So teacher, it would be like you pay rent and you pay, I don't know, the liters of water you use each month?
Well, if it was part of the rent price, yes, but if you had two different receipts, one for the water and one for the rent, and the rent is always the same, then no, because rent will be fixed, water will be variable.
Okay.
Yeah, if you have maybe services included on the lease and rent, and then your landlord tells you all services are included, but I will charge you more the more water and electricity you use. I will not differentiate inside the receipt. I will just charge you more. And then the receipt of the lease comes back to you, and each month is different, but it has a fixed amount and then a variable part that then will be mixed.
Okay, thank you.
Okay, so just to recap then, the variable cost in total analysis, it will rise or fall with the level of activity. On fixed analysis, it will always be the same, regardless of the level of activity. When you are looking at unit costs on the variable part, it will always maintain the same, regardless of the level of activity. And on the fixed analysis, on unit part will always move, rise or fall with the activity. And again, this is like the reason, the financial reason why internet companies are so valuable. This right here gives you the reason why software is so valuable. Because on the unit cost, it becomes a variable cost, even though it's fixed on the total. So why we need to learn that? Well, because that helps you to structure the analysis of cost, volume, profit analysis. It will help you to understand the changes in price structure, changes in business strategy, the effect of the profit has on change in cost, and analyze the effects on the gain of change of capacities, that is normal capacity, and also analyze the sales mixture. So now that you understand how the cost is actually moving and how to interpret it inside the business, you can move to analyze the elements of the cost or a product or a business just by itself. With this analysis, I'm going to teach you to understand the business and actually take business decisions, or if you like a stock market analysis, to analyze a business using this model will help you to better understand the core business of the company. Who knows here who Charles Munger is?
What, teacher?
Who here knows who Charles Munger is?
I don't.
I don't.
I don't either.
You know who Warren Buffett is, right?
Yes.
Warren Buffett and Charles Munger are the two chairmen of Berkshire Hathaway. Warren Buffett is the more outspoken. That's why we all know him, and also is the one who has the biggest stakeholder position on Berkshire Hathaway. That's why he's so rich. But actually, the investment philosophy they follow is the one of his partner, Charles Munger, and he has investment decision analysis separated in two parts. All right. When they interview him on Harvard Business Review, for example, he said that the way they analyze business is that they split business into two parts, and they analyze the decision in that. One part of the business is if it is a brand business. That is, if people will buy the thing that they are buying just because of the brand, and that's why they invest on Apple, on Microsoft, and on Coca-Cola and on Geico, because those businesses have a strong brand. And then they say, if they pass the strong brand analysis, then we move to the business, if it is a good business. And the way they do analysis for good business is they do operating analysis, that is cost, volume, profit analysis. they see if the business by itself it's profitable. That is, they analyze the price structure, the business strategy, the cost mixture, and the marginal gain for each product sold. And when they find a business with a strong with a strong brand and a strong business, then they invest in the business. So this is a way of analyzing a business, not only for managerial accounting inside the business, but also to understand a business and see if you will invest in that business, if you will buy stock. So the six analysis we're going to be looking at are contribution margin, break-even point, profit goals, cost profit volume charts, operating margin, and safety margin. Let's start with the contribution margin. So what is the contribution margin? The contribution margin is how much money you are earning when you deduct the variable cost of sales. It can be also represented as percentage, and it's a total result. I'm sorry, let me just take a little bit of water. So the contribution margin is again sales minus variable cost of sales, and that result should actually be enough to cover fixed expense. If it is not enough to cover fixed expense, then your business is not being managed adequately. As you should analyze further to take decisions. That's the formula for contribution margin, by the way. Sales minus variable cost of sales. Write it down. Let's see an example. We have an ice cream company now, and this ice cream company has the following information. It gives you the sales per units, gives you the price of each unit, gives you the variable cost per unit, and it gives you the fixed cost, and it tells you, hey, what is my marginal contribution? So let's calculate that, okay? So we have the sales, we have the variable cost of sales, and then we have the contribution margin, fixed cost, and operating margin. So which one is the variable, the contribution margin? Well, it's actually this one here. We already know that. It's just sales minus variable cost. So it will be 1 million minus 600,000. That is okay. That's my contribution margin. Great, really simple analysis, only to see if the variable cost of the variable part of the business generates money. We can turn that into a percentage, which is actually called contribution margin. It could be percentage, and the way you do it is you take the contribution margin, that is the 400,000, that example, and then you divide it by the sales, which was 1 million in our example. It's the same you have over here, and now you have the contribution margin, and you can tell the ice cream maker, hey, your contribution margin on percentage is 40%. That means that per each ice cream that you are selling, you are earning before fixed cost 40%. Yeah?
It's like the utilidad?
It's not the utilidad, because utilidad will be, remember utilidad is it's separated on gross, operative, and net.
So
right?
this percentage is more like how much it can cover from the fixed cost?
How much you can also analyze it like that, Katia. You can see it also as the percentage that you have to cover fixed cost. But to answer the question, I think it was Carla who asked it, is not just to say utilidad, because utilidad, that is a profit, it's separated in 3 major profits: gross profit, operating profit, and net income profit. Okay?
Okay.
So utilidad, it's utilidad bruta, utilidad operativa, utilidad neta, right?
Yes.
This is contribución marginal in Spanish, contribution margin. That is only taking into account variable cost. Remember absorbing and variable cost analysis? We are using the variable cost to analyze, okay?
Oh, okay, thank you.
So it's only taking into account the variable cost. And just to link you with what Katia was saying, this result tells you what the extra money you have to cover fixed costs, but not only fixed costs, only to cover also, I'm sorry, also to cover profits.
Okay, thank you.
Okay, so that's, again, look that we are using the total values to do that analysis, but you can also use the unit analysis. That is, instead of sales, you use price, and instead, this is bad, I'm sorry. Instead of sales, you use price, and instead of variable cost, you use unit variable contribution. That is unit price minus unit variable cost. And it's going to give you the same percentage. You see, 40,000, I mean, 40%, 40%. Because it is a proportion, and of course it's the same. As long as the proportion holds, it will be the same value, even though you have unit or you have total. So to the popsicle guy, to the ice cream guy, I'm sorry, we can't tell him. I mean, he asked us for the contribution margin, and then this guy is like, okay, and why is that important for me? Well, it will help him determine the operating profit that he will get from increases or losses on profit from decreases on sales volume. So the change on sales volume times that percentage will give you how much money you generate when you increase your volume on sales or in units. And let's see an example. Let's see, for example, the ice cream man tells us that he's going to sell an additional 80,000 pesos on ice cream. And he asks you, how much money are you going to be earning of variable, how much contribution money are you going to be having? I mean, how much money are you going to have left to cover fixed and profit cost? Well, all you need to do is multiply that by the 40% you just got, and you can tell the ice cream man that after paying the production cost, the variable cost of that ice cream, he's going to have 32,000 pesos to pay for the fixed cost and to get its profit out of that money. Yes? I saw one of you to unmute your microphone, and I thought you were going to ask a question, but you didn't. Don't be afraid. Please ask questions, because I'm feeling I am not explaining it correctly, or maybe.
Teacher, will you multiply it by 8?
Because 8 is the price.
And the 4,000 are the units?
8 is the price, you see it here. I'm sorry, it's the contribution margin. I got confused. 20 minus 12, it's 8. That's our contribution margin on units. It's there, you see it?
Okay.
And 4,000 is the total of units they have, right?
4,000 is the total increase on sales that they have.
Okay, thank you.
So we are telling our ice cream maker friend that if he sells 4,000 more ice creams, he's gonna get, after paying for the raw materials and all the variable costs, 32,000 pesos.
Okay, I get it now. Thank you.
So let's go to the what is this thing called? To the breakout rooms, and then again, let's work on the cases, okay? Work on the spreadsheet says contribution margin, please.
Okay, teacher.
A ver, dejen proyecto. Hi, teacher.
Hello.
¿Sí?
Sí, sería lo mismo, ¿no? Sí.
Sí, pero, ajá.
El contribution margin era
Se
esto.
resta.
Ajá.
¿La resta o la suma? Ah, la resta.
Sí, se resta.
El fixed cost, este ya está, ¿no?
Sí, ya está.
Y ya luego nada más la resta, ¿no? Del 600 menos el 500, ¿no?
Ajá.
Entonces, este que es el contribution margin entre las
Entre
ventas,
las siglas.
te da el porcentaje de contribution margin.
Y ahora
luego-
ese es entre el número de piezas, ¿no? Para que te dé el de unit, ¿o no?
sí, o sea, sería...
It's unit, not units.
Yes.
Unit contribution margin.
How do you get, so it won't be like number of units, it will more be like the unit cost, the unit price.
Entonces sería.
Pues sería unit contribution margin es percentage.
So what is the sales a function of?
Because it's units.
Yes, the sales is a function of units time price, right?
Yeah.
And what is the unit part of that analysis?
The unit what, teacher?
The unit part of that formula? Like, how did you get the unit price and the unit, I'm sorry, the sales and the variable cost?
I think
You multiply the units times the unit price and times the unit's variable cost, right?
Yes.
So what will be the unit contribution margin?
It will be this one.
That will be the general. It's a subtraction, yes, bro, of what? It's on units.
The subtraction of
We have to divide, no?
You have to subtract. You subtract what? If in total you subtract sales from the variable cost of sales on unit, what would you subtract?
¿No sería los margins restarlos?
What about the price?
Like this minus this.
Okay, try it, put it there, and then see if the unit contribution margin with those two gives you the same as with the total. And it gives you the same, you were correct.
Pero déjame. Ve, ya queda aquí raro.
Those sales are on units.
Oh, so it doesn't, okay, yeah. So you don't have to.
You need to multiply the sales times the price to get the total sales.
Okay.
Great.
Great. A leerlo porque iba en friega.
Ah, sí.
You already finished?
Sí, la parte del...
Hi, teacher.
Yes.
I was wondering, have you uploaded the? Yeah, we finished. Abner, can you show it?
Ah, yes.
I was wondering, have you uploaded the presentation you showed before this one?
No, I'm gonna upload it now.
Okay, thanks. I was
No,
looking
I haven't
for it.
because we didn't finish it yet. Now we finished, so I'm gonna upload it now.
Okay, thanks.
So you finished? It gave you the same percentage of marginal contribution?
Yes.
Great.
Thanks.
You're welcome.
Ponlo ahí, multiplica 9 por 75. Te va a dar 675, creo yo.
Nos
Sí.
da lo mismo, ¿no?
Sí, sí, entonces creo que sí es la de 9, o sea, la de 45 menos 36 igual a 9.
¿No
Porque
sería, o sea, no sería lo mismo como lo hice?
no, porque ahí lo estás poniendo de un total, o sea, y el 9 es por una unidad, creo yo.
Exactly.
A mí también está bien.
Ah, ok, ok, ok.
Porque, bueno, da igual el contribution margin, ¿no? O sea, y es el unit, o sea, es por unidad. Entonces, si lo
Sí.
multiplicas por 75, pues sí te da.
Sí, creo yo que es así, o sea, quiero pensar.
And how will you check if what you are thinking is correct?
I think because if you multiply the result the 9 per the sales, it is
The same contribution margin.
yeah.
That's one way. Another way would be also to get the percentage contribution margin on the units. And if it gives you the same percentage as the total, then you are correct.
The same percentage as 20%.
Uh-huh.
Okay.
It will be
So 9 over what?
9 over
this one?
Yeah,
Yes, because it's the one related with the sale. No, that's the units.
no, era 45.
Ah.
Y sí iba a dar 20.
20%. Great, guys. Nice.
Thank you.
Bueno, desde el punto 20,
Ajá.
la ecuación, quita la ecuación, solo pon ajá, y luego abajo pones
45.
ajá, ya.
Ah, sí, no tiene que cuadrar, ¿no?
Perfect. Yeah, it has to match.
Okay, thank you, teacher.
Really smart. Thank you for completing it. So you all got it, which is actually great. You got the same result. It's really simple. This analysis is really simple. It's just fill up spaces and use subtractions and divisions. And one thing that I saw, maybe some of you were a little bit confused, it's that when we are talking about units, we are talking about per unit. That is price and variable cost per unit. That's the only thing that I saw that maybe some of you were confused. And why we have these two methods? Because you can get to the same result by the units or by the total analysis. Okay, so the idea is that you guys know how to do both. This information will answer the following question. First, how much more will I generate if I manage to increase my sales? You have the marginal contribution, so you will know that. What is the money available to pay fixed cost for each product sold? That means that for each ice cream I am selling at 45, I have 9 pesos to pay for my fixed cost. And the other one is, what will the increasing pesos will be if I increase my unit sales? And some of you guys actually did the check of the unit contribution margin by multiplying the sales units times that 9 contribution margin. That actually is how much money you will get if you increase your sales. How much extra money would you get if you increase your sales? And actually that opens a question, because if you know how much money would you get if you increase your sales, then you also can know how much money you need to pay for your fixed cost. So this actually gives you an analysis. It can give you it can open the door to analyze how much units on money, or how much units on money or just units you need to cover your fixed cost. That analysis is called break-even point. So the break-even point is how much money you need to pay for all your costs and expenses. This one here, it's the formula. So the break-even point, it's a fixed cost divided by the sales minus the variable cost of sales. This is the contribution margin. So the break-even point, the formula is actually just fixed cost divided by the contribution margin. At break-even point, the company shows neither loss nor profit. It can be displayed in units or in sales volume. Has there anyone here about the break-even point? Punto de equilibrio.
Me, teacher.
No?
I've heard it on pricing models, but not for this.
Pricing models, yeah, that's well, because again, it takes corporate finance takes analysis from other part of accounting and finance. So, but yeah, what did you hear on pricing models?
So there's a model called Van Westendorp where you ask on your surveys what's the least amount of money. At what price do you think it's a bit doubtful the quality of the product? Then the fair price and expensive, and you found the intersection points between all of this to get like a range, and then within that range, it's your equilibrium point. Your break-even point.
Break-even point. But just think about that. It's the point where you are going to be like increasing. And well, for what you just explained, it could be the point where it changes. If the quality maybe can change, right? Or the whatever you are analyzing will drop. Okay.
Yeah.
That's the break-even point. Also, it's a point. If you graph it, it's the point where you start either making sales or losing money. It's pretty much the same analysis, but right now it's with operating activities. So let's see an example. The same company of ice cream. So you have I didn't translate this, I'm sorry. So the same company, it produces ice creams and it tells you that that company needs to know its break-even point. So I'm sorry about this. This is sales price, and this is unit variable cost, and this is fixed cost. Okay, and the guys at the top of the ice cream company tells you that their fixed cost is 250,000. The sales price is 20 pesos per unit, and the unit variable cost is 12 pesos per ice cream sold. So you know that 8 pesos is the money available per unit to cover the fixed cost. How you know that? Well, the unit contribution margin. Actually, let's do it like this. Unit contribution margin, it's the price minus the unit variable cost. Right? So that's 8. This is how much money you have to cover fixed cost per unit. So if that's the money you have to cover fixed cost per ice cream sold, how much ice creams do I need to sell to pay for 250,000 pesos of fixed cost? Well, all I need to do is just divide it, right? I can just take the 250,000 of fixed cost and divide it by 8, and I'm going to get that on units. And check this out. If I go and take it as a percentage, that is, if I take the 8 pesos and divide it by 20, and that's the percentage contribution margin. I can also get the number in sales. So I can tell my ice cream friend that he needs to sell 31,250 units of ice cream or reach 625,000 on sales in pesos at that price and at that value of variable cost to cover its fixed costs. So let's check if what we did is correct. All we need to do is just multiply the sales times the price, include the variable cost, include the fixed cost, and the operating margin should be 0. And why it's 0? Well, because that's the point on the graph you neither lose money nor gain money. It's a break-even point. Now for the break-even point, it's what happens when this is only with one product. I mean, it's everything clear. I think it's actually pretty simple analysis. It's just a division. Are you guys getting it?
Yes, teacher.
Yes. So what happens if you have more than one product? If you have more than one product, what you end up with, it's something that it's called a sales mix. And if you have a sales mix, you need to use a weighted average cost, weighted average analysis for the cost and for the price, right? The sales mix is the contribution of each product within the total income. In the case scenario, for example, do we have a sales mix? Well, the answer is yes, because we sell different types of flowers. So each flower and each flower sales actually contributes to the price, to the total sales of the company, all right? And for example, I don't know if I'm making myself clear here. It's just that you are selling a bunch of products inside a business, and each product is actually adding sales by its own to the business. So all those sales added to the total sales, that contribution of sales per each product, it's called a sales mix. And when you have a sales mix, then how do you find the break-even point? Because you have different products. So that's the question. If I am selling a lot of things inside my business, how do I find the break-even point in the business? So let's see an example, because I think that with an example is going to be more clear. So on my ice cream business, I sell popsicles and cones. That is paletas y cones, all right? So I have my sales, I have my price, I have my variable cost, and I have my sales mix. So from where do I get the sales mix? Any ideas?
It's the percentage equivalent to the total.
Exactly, it's a weighted average. So my total is 1 million. And I have 200,000 pesos on sales for cones and 800,000 pesos of sales for popsicles, right? So 80% and 20%. That's my sales mix. How do I find then the break-even point on a sales mix? Well, you need to apply a weighted average. And applying a weighted average is basically just multiply the average of contribution of each of the products times the units that you want to weight. So we have popsicles and we have cones, all right? And let's see what I mean with weighted average. You just multiply the price of the popsicle times its average, its weighted average on the sales, and you get the proportion of price of the popsicles to the business, okay? You do the same with the cones, 35, but this time we multiply by 20% and you get that. And then you do the same with the costs. You have the unit cost, you multiply by the percentage, by the weighted average, and you get the variable cost. And then you do the same with the cones, this time by 20%, and you get the other one, okay? Now the company has a price on sales mix of the addition of these two as weighted average. So the price of the company on the weighted average sales mix of these two products is 43, which is the addition of 36 times that by 7, plus 7, I'm sorry. And the variable cost, 26.4, which is the addition of 20 plus 6.5, 6.4, right? And from where do I get this number? Again, remember, this one comes from multiplying the popsicle price times the popsicle sales mix. This one is the price of it times, right? And so on. Yes, guys?
Yes.
Yes, everyone?
Yes, teacher.
Okay. So now that I have that, now I can get the company's unit contribution margin, which is the number that I need for my break-even point formula. So if I have now 200,000 pesos of fixed cost, all I need to do is just divide it by the unit contribution margin, and then I find the break-even point of the business. Now, how do I convert that to units of paletas and conos? Well, I know my sales mix. I know that of these 12,000, 80% are going to be popsicles and 20% are going to be cones. So what I do is just multiply the total units at break-even point times the sales mix. And now I have my break-even point per units. And I can tell my ice cream maker friend that for that value of sales on sales mix and volume of fixed cost, he needs to sell 9,639 paletas and 2,410 conos to actually cover both its variable and fixed cost. Yes?
Yes, teacher.
So the fixed and variable cost on break-even point when the fixed and variable costs drop, you will actually drop your break-even point. The break-even point will be lower. When they increase, your break-even point will increase. And that happens, it's inversely, ¿cómo se dice eso en inglés? I forgot. It's the correlation is inverted when you are talking about price. On the break-even price point, if the price goes down, the break-even point goes up. And if the price goes up, the break-even point goes down. So the next part is let's build the break-even point. But right now it's 8:48. So I don't know if we have time to actually check the analysis and then do the review because it's like 20 minutes. So I'm gonna leave that for next class. Next class, we're gonna start checking the break-even point. I'm gonna do like a quick recap of what the break-even point, and then you're gonna go to the breakout rooms and work on Monday on that. Okay, guys? Or
Okay.
you want to say it now?
Okay, thanks.
Do you think you can nail it on 5 minutes?
No. Maybe next class, teacher.
So next class it is.
So we can correct it or check it.
Okay. I actually told you we were going to say yes, guys. Like, yes, teacher, let's do it. I can finish it in 2 minutes.
Yes, teacher.
Yes?
No.
No.
Okay. So let's finish the class now, guys. See you on Monday. I will be reviewing your submissions that you did of the project. As far as I'm going right now, because I have checked some of them already. You actually, I think, well, the ones I checked at least are showing that you did a good job. So wait for the review of that to work on changes. And see you next week.
Okay, teacher, goodbye.
Thank you, teacher.
Bye.
Teacher.
Thank you, teacher.
Teacher, I have a question
What is your question?
about the model test. It is going to be like theoric or
It's going to be both theory and also practical exercises.
okay, and it is going to be in Canvas?
Yes, it's going to be
we
in
have
Canvas. No, it's going to be in Canvas.
And the practical part is also like only like we do it and we answer, I don't know, like the question in Canvas or.
For example, I'm gonna tell you what is the break-even point when this amount of fixed cost and this contribution margin, and you need to tell me.
Okay.
And you write down the answer there.
So
when is
When it's going to be the last class of next week.
Okay.
This is week 4 or 3, guys?
3.
I think 3.
Yeah, great. Then yes, so it will be on next Tuesday actually, 26. We're gonna finish this on Monday or between Monday and Tuesday. I am sure of that. No, wait. classes are Monday, Wednesday, and Thursday, right?
Yes.
So we're gonna be finishing this on Monday, and maybe on like on Wednesday at 8:30. We're gonna be finishing this, maybe sooner, and then the exam is gonna be on Thursday, 26.
And
this is the last topic of the course.
Okay, so the questions or the answers are going to be like multiple choice, or
it will be multiple choice and also open answer. Like I will be, you will need to answer it correctly with put the exact number on the answer.
Okay.
Yeah.
Teacher, thank you.
You're welcome.
Thank you,
See you next
teacher.
class.
Have a good weekend.
You too. Bye.